India maintain its growth momentum in a world where it is being shaped by energy insecurity and geopolitical risks all the time? The World Bank report has given us some hope, some confidence, where it has projected 6.6% growth, but it is not devoid of cautions as well. Hello everyone, welcome to Vajiram and Ravi's Flash News. My name is Shubhangi Singh, and in today's session, we are going to understand that what are the growth engines that have enabled the projection of 6.6% GDP growth, and also what are the cautions that have been highlighted by the World Bank. So let us begin with understanding that what does India growth look like as per World Bank. So as per the latest updates, World Bank says that our growth will moderate at 6.6% for this very financial year. Now when we are talking about the estimates, yes, we get to see that the estimate has dropped down, especially if we compare it with last year. But at the same time, you have to look at the silver lining that India remains the fastest growing economy with this growth rate. Where we are talking about developed economies, they are lurking somewhere around 2 to 3%. And then if we talk about the middle bracket, then we are looking at the growth rate of 4 to 5%. In this context, India at this number comes out shining. So this report is not just about this number, it is also about what are the things that have enabled this number, and also the things that India needs to take care of, India needs to be cautious in order to maintain the resilience and handle the external risk. So now that we have understood what exactly has been highlighted in terms of growth number, let us also look into the growth engines or the growth drivers which have helped in enabling 6.6% growth. So the first biggest factor in this is the macroeconomic buffer and the macroeconomic condition that is present of our country. Now when we look at it, let me give you an example here. In recent times, when we are talking about this very year, we saw that our forex reserve went and touched ahead $701 billion. But at the same time, because of the recent rupee depreciation, it has come down to now $688 billion if we talk about today. That still gives us a heavy cover. That means if we talk about the term import cover, that how many months of import will be covered through this forex reserve, it stands at 11 months. Now this is a whole big assurance that is for us, given in the crisis situation as well. We have this buffer present with us, and this buffer will give us a cushion to any sort of currency volatility that we'll see, and we have seen that this has given cushion last week itself when RBI used forex reserve to stabilize. When we are talking about the falling rupee, we saw rupee touch 95 per dollar twice by the end of March. So in this situation, currency volatility can be handled better, external shocks can be handled better. Then the second growth driver here is our banking sector, which looks robust and strengthened as of now. Because when we look at the banking sector, NPAs have reduced, banks as of now are well capitalized, and also the credit growth, if you look at the number, that is also stable. So three important factors: limited NPAs, reduced NPAs, strong capital base, and credit growth is increasing. Now another important factor internally that is driving growth is the domestic demand. Now when we are talking about domestic demand, first thing that is facilitating domestic demand itself is the amount that government is spending. So government expenditure, be it for infra, be it for facilitation, be it for creation of new schemes, other, that is being seen, and we are also seeing urban consumption is increasing. And across these three important factors, we are seeing one biggest contributor which brings all of these together is the policy stability. Here you have to bring in the aspect that how our central bank, that is RBI, is handling inflation targeting, how it is reliable, how it is structured, how it is data dependent, and at the same time over the years how fiscal discipline has been tightened. both of these policy, monetary policy and fiscal policy, have been credible and structured over the years in order to ensure that these factors do come in front of us. But at the same time, this is a big factor where we see that our growth numbers are increasing when others are not. But at the same time, as I said, this is not devoid of risks. There are certain things that we need to take care of at this given point of time. Otherwise, we would be not looking at growth drivers, we will be looking at growth diluters. So what are those risks? So the biggest risk is definitely in front of us in the name of West Asia crisis that we are seeing. And if you look at West Asia, we have Strait of Hormuz, which was blocked almost for 4 weeks, opened for a day and closed again. There were a lot of threats on Bab el-Mandeb Strait, and Suez Canal was also threatened. When we are looking at Strait of Hormuz, 20% of global oil supply. When we are looking at Bab el-Mandeb Strait, we are talking about 5% of oil supply, and similar numbers for Suez Canal. So constructively, we are looking at 30% of oil supply being stuck in a huge region. And India being excessively dependent for crude oil, this creates a situation where conflict has already increased prices, and gradually we will see this price reflect in everyday commodity that we are going to buy. When inflation heightens, it stifles the growth. So as a result, India needs to worry about how they are going to manage this energy insecurity that is coming up. They have to look into supply disruptions, not just the things they were importing, but also the things they are exporting. For example, makhana industry suffering a huge setback, India basmati rice suffering a huge setback, and the list is very long here. So these supply disruptions also need to be addressed in order to ensure that export and import of our country keeps running, because when we were talking about forex reserve and the stability, foreign exchange is an important component. And when we are talking about increased inflation, this will be a form of imported inflation. We have to understand and address that how this needs to be tackled. Now, these two sides have been highlighted in the World Bank report, that yes, these are the growth drivers and these are the risks that India needs to be prepared for given the West Asia crisis. But when we are talking about these broad risks, we also need to understand how they translate into stress for the economy, what kind of macroeconomic problems they create. So now let us take a deep dive on that end. So first, if we are talking about macroeconomic pressure, one is very clear that we have talked about twice now, that is inflation. As of now, it is projected to be 4.9%, driven by fuel and food, both of them being expensive. And that is why day before yesterday, RBI took a cautious stance where it kept the repo rate unchanged, because they said we don't know what might be coming. We need to be data dependent and cautious. We cannot bring in rate cuts and rate hike in such a volatile environment. Another factor that will directly enable a macroeconomic stress would be currency's volatility. We have seen in past 15 days how our currency can depreciate in the effects of geopolitical instability and also speculation. That is why RBI went ahead and banned the NCC derivatives. Apart from that, when currency depreciates, the investor confidence in the economy also starts shaking, as a result, which leads to capital outflows. In past 1 month, we have seen capital outflows worth $19 billion. So there are certain macroeconomic stresses that have already started showing up, and these might multiply. For example, if you look at the industrial sector, the input cost is already increasing. You can already see that the profitability that existed, that is being impacted, and that is going to threaten the industrial output as well. And this is not limited to domestic internal scenarios, it will also have a direct impact on the external sector as well, where the current account deficit is expected to become 1.8% of GDP. If we look at previous numbers, we have worked over the years to make sure that the current account deficit stabilizes well below 2%. if it is expected to rise to 1.8% now. We don't know if this crisis continues, even though there has been a ceasefire called, what number will bill up here. Furthermore, we are also seeing a direct impact on fiscal aspect, where given the rising cost, the burden of subsidies on government has increased, and at the same time, given the bump in the economy, the taxation or the revenue that they were getting in terms of especially excises, that has reduced. If you remember, government has reduced rupees 10 per litre petrol and diesel excise duty last week itself. So in this context, government is going to face a twin deficit problem. Current account deficit would be an issue, but at the same time, fiscal deficit would also need to be handled. So in this scenario, the risks the World Bank has highlighted have already started showing effects. They might multiply if the problem continues. So what should be done? What should be the way forward? In this scenario, it is very important in short term we use our strength, and this all needs to be done to ensure that in long term we have reduced our oil dependency and we have strengthened the factors, not just manufacturing, the macroeconomic factors, that geopolitical crisis do not shock our nation and economy the way that is happening as of now. As we see, if we compare it to 1990s, the Gulf War crisis, the impact as of now is limited. This happens because of a lot of factors, not just economic. We have diplomatic factors at play, also geopolitical factors at play. But at the same time, we have to ensure that we dial down on the risk or the weaknesses and play on the strengths. What are your thoughts on this? Let me know in the comment section. That was all from my side. Thank you so much. I'll be leaving you here with the prelims practice question. Let me know the answer in the comment section. Thank you so much.